Joining us now is Marathon Asset Management Chairman and CEO Bruce Richards. Reminder, Marathon has $20 billion in assets under management. Always good to see you. I do want to talk about the Fed and inflation and everything, but I think we first have to start with the Middle East and what's happening in Israel, because you see this as a macro challenge for the markets, for the economy?
Well, first, let me say that we all pray for peace and stand with the President of the United States, who stands staunchly behind the support of Israel. I say that as a personal citizen as well as the CEO of Marathon. Listen, Israel is a great credit. It's an A-plus rated credit. It has a strong currency. The equity market's done well over time. Its bonds trade well. And its debt to GDP is 60%. So in terms of risks residing in markets within Israel, they're at war right now. We hope that it ends swiftly. But my base case is wars, like they tend to take longer than one thinks. And so as long as it doesn't drag in other regions and bad actors that might want to enter.
Iran is the wild card, right?
Other bad actors that want to enter, then I think it'll be quite contained. But that black swan is sitting there, as you know it, and it's real. And so we're considering that as a risk factor. And for right now, energy, has been a bit softer, which is a little surprising given the turn of events. But we'll see, because it's early times.
So you say you have to prepare for that risk. Just tease that out a little bit. You're saying that if there's more smoking gun around Iran here.
It's just one of the risk factors that might cause inflation to be higher for longer. Just like add that as another log onto the fire. And we saw the PPI numbers this morning, and inflation is higher for longer. Although it's softening, it's going to be firm at this 3 handle or higher for longer, which means the Fed has got its work to do. And there's a lot to talk about then. Are they done? Well, the big date for me tomorrow, of course, we have CPI, but it's October 26th. And what you're going to see on October 26th is third quarter GDP. And this is remarkable, because the Fed chair himself talked about 2.1%, and his economists, 2.1% GDP for the third quarter. It's not coming in at a 2 handle. It's not coming in at a 3 handle. It's going to come in an upper 4 handle, is what we're seeing right now. Because real GDP has been running quarter after quarter after quarter around 6. And it's going to accelerate in third quarter, because when you see strong jobs and you see growth, what it's been because of the fiscal stimulus, you're going to see a really strong GDP print. So I ask you, when the Fed meets October 31st, Halloween Day, and when they come out and adjourn and announce on November 1, what are they going to do when they see 336,000 jobs created just last Friday, plus 100,000 revision higher in the prior month, plus GDP accelerating? So this whole narrative of the higher rates has done the Fed's work. Nah, I don't think
that's
so.
That's what they're talking about, though.
That's
Despite
what they're talking about.
It feels like they definitely want to pause.
That's what they're talking about, but that's not what happens. And so that's what's not happening. So I listen to John Maynard Keynes when he says, when the facts change, I change my mind. What do you do, sir? And so these facts are changing right before them. They themselves thought a 2% GDP print. This is the Fed, come October 26th. And now you're going to see a 4, or the Atlanta Fed now says 5.1% nominal GDP print on that day. So what do they do the following week? I ask you.
Pause.
But
you say they should. I mean, it looks like they're coming to the realization that they have done a lot. If you monitor all the Fed speak in the last week and a half, it's the long rates are doing the work for us. We can kind of wait to see how that shakes out.
I'll take the other side of that, but that's okay, because the Fed's already moved 525 basis points. So the fact that they have one more left in them is really not my focus. My focus is for all of next year. The markets are assuming, as they always have wrongly, from March of 22, from the beginning of the tightening cycle to today, that the Fed would be easing 6 to 9 months out. And I see rates higher for longer at these higher rates for all of next year. And that's the big disconnect. And that's what's given a bid to the equity markets all along. Don't sell, because the Fed's going to be easing soon. And when the markets realize that the Fed won't be easing soon, I think that's the awakening that is going to be really impactful for equity markets.